Good morning, everyone. This is Rob McDougall from Zhang Financial here with a intra-week weekly update, market update. Today is Friday, April 4th, 2025. Normally, we do our podcast on Monday. Sometimes it slips into Tuesday. We're doing a Friday podcast today for two reasons. One, markets are in a bit of turmoil this week. Number one and number two, I'll be out next week, so we will not have a podcast coming out on Monday. So, just wanted to update everyone on the economic situation, where the markets are at, and our thoughts on it. So we'll just start off real quick on the economic data on a week-to-date basis. So from early Monday until now, we'll just say the economic data is actually relatively good. So we had ISM PMI earlier in the week. That was on Tuesday. That was in line with expectations. We had the ADP employment change. That's an important metric, a labor metric on Wednesday, and that came in much better than expected. ADP expected 105,000 additional jobs in their survey. They came up with 155. Initial jobless claims the next day on Thursday, pretty much in line, actually better than expected. It was expected to come in at 225,000 new claims, only 219. The biggest economic data of the week, which is getting a bit overlooked today, and we think this is very important, labor markets. So the non-farm payroll number came out this morning, Friday. The expectation was consensus 135,000 new jobs, non-farm payroll. It came in at a very surprising and strong 228,000. So for those that think maybe the labor market, the wheels are coming off, this certainly squashes that thought, at least for the moment. So that's a very, very strong indicator. Labor markets have not rolled over. The average hourly earnings came in as expected, increase of 0.3% month over month. Unemployment rate did tick up from 4.1 to 4.2. I've mentioned many times on this podcast, we don't really, we follow that metric, but it is a bit spurious because it really depends on labor pool participation, which can move all over the place. So many estimates involved. So an uptick of 10 basis points we think is inconsequential. So the big news this week, though, was the imposition of additional tariffs. President Trump on Wednesday had a volley of new tariffs against all of our trading partners, pretty much. Imposed a minimum baseline global tariff of 10% on all countries, and for some countries, tariffs would be as much as 49%. He did not announce new tariffs on Canada or Mexico. But it really rattled the markets. That was Wednesday night, so we had a very difficult day in the market on Thursday. And then it was followed by additional tariffs on China. So China, the tariff now has been moved up to 34%, and China responded last night, with reciprocation. So they're going to increase our tariffs by up to 34%. So a bit of a mess on that front in terms of the tariffs. There's not an easy solution. Market hates uncertainty. So the real question for investors, for us, for you, is what is the ultimate goal here for the Trump administration in terms of tariffs? There is a thought, and President Trump has promoted it himself, that it's a wonderful tool for revenue generation. Any economist, virtually every economist, would say that's not a good reason. It's a very bad reason. The only other good reason for doing it is negotiating tariffs down from other trading partners. We're still holding to that. Trump, at the end of the day, President Trump is shown to be a good businessman. It looks like a hardline negotiating stance. And so our hope in the next several weeks is the negotiations begin and he backs off and we come to a better agreement with our major trading partners, China, the EU in particular. So So, additional news during the week, GDP estimate from the Atlanta Federal Reserve. Recall, I've mentioned this on other podcasts, that they are really super negative on the first quarter GDP estimate, and it looks outsized. They actually improved their expectation for first quarter GDP growth from a negative 3.7 to a negative 2.8, but that was only because they expected less input or imports of gold. So it's not really fundamental. So they're at a negative 2.8% expectation for first quarter that we just finished. We'll be stunned if it's really that bad. It could be doubtful. There's just a survey out this morning, CNBC, 14 top economists, whatever. Their expectation, consensus, is between the 14 is barely positive, but a 0.3% GDP growth in the first quarter. Inflation expectations with all this, so obviously tariffs will hurt inflation, but maybe not surprisingly, I was going to say surprisingly, maybe not surprisingly, expectations for inflation has actually been coming down. So it got up to about 2.45% expectation average over the next 10 years. It is now down to 2.28%, and just this week it's dropped 9 basis points. In terms of Fed funds and what the Federal Reserve might do, there is a May meeting, and in that May meeting 2 weeks ago, no chance whatsoever of a cut. Now, the chances of a cut are 44%. So expectations is we'll get 44% probability we will get a cut in May, but the odds of the end of the year have changed dramatically as well. So the odds of 2 or more cuts, that is increased week to date from 66% last Friday to 99%. And then 3 or more cuts, the probability of that, I don't recall what it was a week ago, but that has moved up to 89%. So market is pricing in strongly 3 to 4 Federal Reserve cuts by the end of the year. So we'll talk about the returns on the market week to date, year to date. I'll just note one thing in terms of a year to date market. On a year to date basis, S&P through yesterday, which was Thursday the 3rd, down almost 8%, equal weighted 500 index down 4.5%. So the Magnificent Seven definitely lagging. But it is negative 7.3%. Not to diminish that, that's definitely not a good thing. But the average annual drawdown on the S&P 500 over the last 30 years, the average annual is 14.4%. We might hit it. Things could get worse, but the point being is that it's getting a lot of press. The magnitude of the number is not that high at this point. So on a week-to-date basis, not great, obviously. S&P 500 through yesterday down 3.3%. Equal-weighted S&P actually a little better. But the big difference is growth versus value. Growth has been getting hammered all year. Growth is down 12.6% year-to-date. Value up slightly, 80 basis points. This week, growth down 4.3%. Value only down 2.4%. In terms of the rest of the world, week to date, definitely better than U.S. Again, developed ex-U.S. down 1.4%. Emerging markets only down 1.6%. The big winner this week, fixed income. The 10-year through yesterday was down 21 basis points this week. That's huge. So that means the Bloomberg Aggregate Bond Index up a full percent through the first 4 days of this trading week. However, bonds are up huge this morning, so it's another 9 basis points. So takeaway here is that the 10-year has dropped significantly, so long bonds have done well. And at this point now, the 10-year has moved from a yield, let's just call 4.6% 5 weeks ago, down to 3.94% this morning, Friday. Very quickly, economic data this week. We'll just go through a couple of the big data points because not all the information is populated in our databases. But on next Thursday, we do have core inflation rate, the CPI, core, and headline. For that, the headline number is expected to be up 0.2% month over month, and the core 0.3%. So if those numbers hold, the inflation rate year over year, the headline number will be up 2.8%, the core up 3.1%. On Friday, then, we get PPI, Producer Price Index, month over month. That is expected to be up 0.1% for the month of March. That was flat in the month of February. So PPI, Producer Price Index, is actually seems to be under control. So the year over year, 12-month, if it does come in at that 0.1 increase for the month of March, will be up 3.2% year over year. So we'll just conclude on a few notes here regarding what is going on with the tariff negotiations or tariff war at this point, and our thoughts on that. So in total, the U.S. economy, no doubt, it slowed in the first quarter versus a very strong growth that we had in the fourth quarter, 2.4%, 2.8% for 2024. I think it was positive for the first quarter. Probably the most encouraging data point was just this morning. That jobs number was fantastic. If you're adding jobs, any economy, if you're adding jobs, your economy certainly isn't horrible. So that was a big number, a big beat in terms of additional jobs gained last month. One concern, we'll just note it to be fair, is the consumer confidence number. I think it came out last week. It was the University of Michigan consumer sentiment, and that was well below expectations and the lowest we've seen in 2 years. So obviously that's very important. Consumer 70% of the spending, so that's something we will keep our eye on, watch the retail numbers, see how the spending patterns go. So that's a bit of a concern. But here are some of the encouraging things in terms of potentially the market turning around, particularly on the equity side. One, volatility right now. Because of the uncertainty, nobody's really sure where the tariff war is going. So the VIX index, which measures volatility in the market, this index had been at a very low and stable level for most of 2023 and 2024. The metric was between 12 and 14%. There were a few hiccups in there, but that was kind of the run rate. Right now, this morning, it's at 38. So that's an extremely high level. That will definitely, no matter what happens, that's going to come down. When volatility decreases, you would expect stocks to move up from their levels now. One indicator that we also look at in terms of potential future equity markets, the AAII index, American Association of Individual Investors. It's a contrarian indicator. We pull this out only at the extremes when investors are really bullish or really bearish, and it is contrarian. So when you get under 20% that are bullish, the numbers are amazing. For the next 12 months, the S&P 500 since 1987, when it's happened, bullish, less than 20%, the S&P has returned 19%. When it's over 60% bullish, the S&P 500 over the next 12 months has only been up 3%. So right now, we're bumping along right around the 20% level. 4 weeks ago, we were both below 20. Now we're a little over 21 at this point. But directionally, this would suggest retail investors are great at timing. So this augurs well, I think, for the next 12 months of S&P returns. But the last thing that we'll say in terms of optimism for the market is right now it feels like we're at the height of uncertainty. We're not sure. It does remind me of the early COVID days. But here's the biggest difference between COVID or the housing crisis or the 2022 very poor performance of almost all asset classes. And that's the real issue, the crux of what is weighing on the equity markets at this point is the tariff issue. And this is one of the most easily fixable things that you could have for the economy. Certainly, if we come to some sort of agreement, we either back off or negotiate lower levels across the board, or particularly with the EU and China, you will most definitely see a huge pop in the equity market. So, as we always say, we can't time the market, and we're not saying we're going to see a quick rebound. We're not going to say there will be some negotiation in the near term regarding tariffs. We simply know this: timing the market is always futile. Any academic research you look at comes to that conclusion. We can't time it. We don't try to. We manage through these cycles. And so I would simply say it does look uncertain right now in terms of the equity markets, but we have a lot of positive things going for the U.S. economy, particularly the labor markets. And if we get past this level of uncertainty regarding the tariffs and the impact they might have and what ultimately they look like, that would be very constructive for equity markets. So thank you very much. This is one of our longer podcasts, but a lot of stuff to go through. We thank you for watching. We won't be here next week. We'll see you in 6 business days. Thank you.